It's 6 o'clock in Torun in Poland today, 5 o'clock in London, midday in New York, 12 a.m. in Hong Kong, 3 a.m. in Sydney, 9 a.m. in San Francisco, and 9:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID livestream, Series 27, Episode 1, that makes in the aggregate episode number 157, starts here. And we begin today, ladies and gentlemen, with really tragic news from the parish of exchanges. The exchange parish has been rocked this week by the news of the death of actually not just one, but both members of an incredible management team. They formed a true rock star management team in markets. Valet to Sir Brian Williamson, the man who was brought back in at the nod of the Bank of England as the executive chairman of Life to rescue it. He was, of course, the chairman of Life in its earlier stages. I do believe he was the second chairman of Life, if my memory serves me correctly. Sir Brian came back to rescue the firm. He brought in Hugh Friedberg as his CEO, and tragically we have just learned that Hugh also succumbed to a long battle with illness during the course of the summer. Brian, on the other hand, was actually in the fittest of health, or so it seemed, until a sudden illness took him just at the end of last week. A very tragic incident. I don't really know what to say, ladies and gentlemen. I am truly saddened. Brian was one of my mentors. He was an absolutely phenomenal man, a truly great person. Check out some of the things people have been saying about him on our Exchange Invest LinkedIn feed. The words that come through: integrity, a man of trust and honor, my word is my bond, and truly a great gentleman. At the same time, within it, beat the heart of an incredible manager, organizer, strategist, and above all, someone who was willing to go forward and push marketplaces forward. Sir Brian, rest in peace. Hugh Friedberg, it is so sad to lose you. You were an incredible, impeccable manager of markets. Without you, I don't believe that Brian would have been able to make the same impression he was in rescuing the whole organization. If you want to read more, a tribute to Hugh will be online very soon via Exchange Invest. Equally, we have a tribute up there already. You can catch it free of charge, even if you're not a subscriber at Exchange Invest. It's also on Medium and LinkedIn via the Exchange Invest handles. Moving on, ladies and gentlemen, some more interesting news from the parish itself as we say farewell to Sir Brian and Hugh Friedberg. CME are increasingly flying a protectionist flag to keep out competitors from the American market as they look to be running scared of Howard Lutnick's latest challenger, FMX. However, Terry Duffy's quotation zinger this week, "The laws of the United States need to prevail over its own sovereign debt," is a fascinating line for a firm whose modern success was broadly built on a futures contract trading the overseas US dollar yield curve out of London. Whatever. It would seem that certainly CME are somewhat terrified whatever Howard Lutnick is doing this time round with his LCH cleared futures exchange. Meanwhile, SIBO's CEO, Mr. Tomczyk, still has an appetite for deals, having been replete only a few months ago. Not sure what to make of this, except that SIBO messaging remains, well, erratic as always. Finally, in our cold open segment this morning, terrific news from Hong Kong as the HKMA have established their CMU OmniClear subsidiary. That's going to be settling cross-border bond transactions from the mainland. Full yield curve trading at Hong Kong exchanges. Here we come in the near future. And congratulations to former IPO-VID guest James Falk, who helped forge the path forward with the Hong Kong Central Bank in this regard. Today, our guest is the fabulous James Ashton. He's going to be discussing the quoted companies agenda, former Evening Standard and Sunday Times City editor. So in other words, frankly, two of the most important positions in the British newspaper industry as it approaches the stock market. James is the CEO of the Quoted Companies Alliance, and I do believe he's been in situ now for almost precisely 2 years. The Quoted Companies Alliance is a member organisation we'll learn more about in a moment. It champions small and mid-sized companies whose shares are publicly traded. James is the author of several business books, and most significantly, from the parish perspective, he was the co-author with Mark Makepeace of a previous IPO-VID Exchange Invest Book of the Week, FTSE, the biography of the incredible index company. That was, of course, with IPO-VID alumnus Mark Makepeace, who was a previous guest on this show as well in, let me see, what was that? Oh gosh, as early as IPO-VID number 15 in 2021, back when there was a thing called COVID. At the same time, James also chairs Oscar's Book Prize, the annual search for the UK's best picture book, presumably replete with books about bond trading, I suppose. James is also a non-executive director of Finsbury Growth Income, the FTSE 250 investment trust. James, Ashton, welcome to the show. Where in the world are you today?
I'm in London, Patrick, and your intro means my life has just flashed before my eyes.
Well, it's actually quite incredible because I can't think, have there been many people who were both the city editor of the Sunday Times and the city editor of the Evening Standard? Because you're the only person I can think of who did both.
I think a few have gone between. I'm not sure about titles and so on, but I mean they were both great fun. They're both very, very different disciplines. Yeah, and people say, "Do you still write?" And I feel like I'm writing more than ever.
Yes, I can imagine you're writing more than ever, and nobody sees it in the same numbers whatsoever, which obviously makes life very, very different. So tell me a bit about, I mean, how did you get into journalism in the first place in the city and so on?
Oh, right back. So, I mean, journalism, I was always fascinated with stories and what was going on. There was competitions at school that I got involved in, and then at university, I think I spent as much time in St Andrews in Scotland. I probably spent as much time on the student paper there as I did doing my English degree. And so it seemed very obvious that beyond university was how to push on into journalism. And that was through, I did the City University course, which is quite a well-known postgrad newspaper journalism. And then from there to Reuters. And it was always journalism. It just wasn't always necessarily financial journalism. And then you get into the world of work, Patrick, and you kind of, follow the groove.
You follow the groove indeed, but on the other hand, the City University and going to Reuters was a great grounding for anybody. I think it's impossible not to manage to progress your journalistic career once you've seen the amazing news writing empire of Reuters.
Oh, definitely, I think, and I was. It was I was on a specialist desk writing about advertising and media, so I wasn't doing the 7 a.m. snaps so much, but it was a great introduction to journalism, and the degree of accuracy and sort of fact checking that they did there is something that I've really sort of carried forward.
Yeah, and I mean, obviously, when you're at the Sunday Times, because really the Sunday Times is. Well, the Sunday Times always had its slogan was, advertising slogan was always the Sunday Times is the Sunday papers. But certainly, as far as being the newspaper that everybody with every quoted company wanted to splash in, you must have been very popular.
Well, I think you mustn't forget that there's quite a number of people who don't want to appear in the splash in the Sunday Times. And so you weren't always that popular. But I certainly think, yeah, it was, doors were open, and I think you just have to make sure that if the door is open and the access is good, you make the best use of that access, whether it's a story for this week's paper or it's a relationship you're building up over many years. You absolutely need to take advantage of what the Sunday Times offered. And I think that the Evening Standard was, if I can explain it, they're so different because with the Sunday Times, you're very much leading up to that big hit a week. So, Thursday night to Saturday lunchtime is quite a blur. Whereas, and then you get to sort of like, try to, relax, refresh, reload Sunday into Tuesday. Whereas the Evening Standard was, a much quicker news cycle, a much sort of more frequent adrenaline hit, if you like. You could file at lunchtime, go out and have a good lunch, pick up the paper, on the way back to the office. And if you went to a drinks party that evening, the chances were, if they were CEOs, business leaders, then people would have read your column coming into the party that night. So that's either a welcome thing, or if they didn't like what you write, it's not always a welcome thing, but you knew you were being read.
Yeah, but you knew you were being read. And I think that's one of the great things. And you're getting certainly such a hit of constant feedback, because wherever you went during the course of Monday through Friday, people were talking to you about something that you'd written or something you'd said, good or bad or indifferent, whatever that may have been. And that certainly makes for a very, very lively lifestyle. So What on earth drove you from that exciting existence to decide to take up the boss of the Quoted Companies Alliance?
I mean, I was working for myself for several years. There comes a point when you can't spend all your life in a newsroom. I think it's fair to say. And so I was self-employed for a while. I was writing, consulting. I had a podcast. I wrote books. You've referred to them kindly. I joined a board. You talked about that. And just at the point, Patrick, when you think you are self-sufficient, all the plates are spinning, the opportunity came up, and I'd known the QCA for a while, and I'd chaired some of their conferences, and I knew my predecessor well, and it felt like a great opportunity. I think it's great to run something. I think the subject matter is fantastic. The membership is vast and varied, and it felt like a really good next step.
And it is interesting. I mean, it's a great business. You mentioned there, Tim, your predecessor, and obviously he'd been there. Gosh, he'd been there for so many years. I mean, like 12 years or something, which is quite a remarkable run for anybody in these sorts of organizations. And you took over, and we'll talk about the sort of the inherent change that's been going on at the moment. But the QCA itself, fascinating membership. Drill us down, particularly for, say, our viewers in America or continental Europe, who might not be so au fait with it.
So the QCA has quite a heritage. It goes back actually 32 years. And so what are we today? We champion public equity. We particularly represent mid and small cap companies that are quoted. They're on AIM, which is the UK growth market. They might be on the LSE's main market. They might also be on Aquis, the challenger exchange. And we represent them with government, with regulators, and with the media. And we think their interests, their needs are distinct to a lot of those companies, the giants that populate the FTSE 100. So particularly, we fight to make sure that new regulation is proportionate. That means it works for companies of all sizes. We want the public markets to be open for a micro cap, just as they're open for a mega cap. And actually, our companies range from 3-5 million market cap on AIM, up to several billion on in the FTSE 250. We have more members in the FTSE 250 than we've ever had. And generally, what do members want? There's been a lot of challenges for the public markets, and we might come on to some of that, and the challenges of de-equitization. There's a lot more private capital around, but we want to make sure that companies don't have to deal with more cost and complexity than is absolutely necessary. We want to do what we can to make sure that liquidity is available for them, and do our bit to boost that narrative. To remind people that why public markets are good financially and good socially.
And I think that's a great thing. And certainly, well, speaking as the publisher of Exchange Invest, we're right behind you four square, because we fully believe in public markets, and the more of them, the better. And certainly one of the things, I think, just taking a step to one side, that has been incredible over time has been how the London Stock Exchange has traditionally been a very, very deep market, and always has had not just LSE itself, but a number of initiatives trying to encourage small medium equity. We don't need to go into the history of them all here, but the truth is it's something that has been a continuous factor in the LSE's history pretty much throughout time, and London Stock Exchange history throughout time, and particularly in the last 30 or 40 years, which has driven your membership. And actually, it's an interesting point you make, James, that you're 32 years old, which means you're actually 2 years older than the European Federation of Securities Exchanges, which I applaud you for being. That's quite an achievement altogether. So QCA, you represent these companies. You try to help along as a kind of I hesitate to say you're a trade union for those companies, but you're essentially a member-based organization trying to represent their interests at various elements of government.
Absolutely.
There's obviously been a lot of change in recent years, particularly none other than post-2016, where obviously the UK has been working its way out of the European Union. Obviously you arrived pretty much just as Brexit was being done, as best we can possibly describe it. How did that change the way that the job has been focused for you?
I think if I think about what my priorities are, it would be, there are, I suppose, some after effects of Brexit. There are also other changes. I think the collapse of the Neil Woodford fund was something that fundamentally affected how small caps were regarded. There's still something that we're dealing with today. But I think the most obvious Brexit implication would be that you can also almost trace it back to 2016, how international investors took a slightly less positive view to investing in the UK. And we think actually, interestingly, with a new government, hopefully a stable government for the long term, that versus all the other stuff that's happening in Europe, that international investors might switch back into the UK now. But my priorities were, I suppose it's what really makes that difference. I think a real focus now is how do we get the capital flowing into these companies. There's been some structural changes. You've probably covered off, changes to the listing rules brought in July by the Financial Conduct Authority. That was a long journey. If I think about when was day one for UK capital market reform, it goes back to November 2020, so the depths of COVID. Rishi Sunak, as Chancellor, not as Prime Minister, kicked all this off. Lord Hill came in to do his review, and since then we've had take your pick. We've had a review for everything, and we're finally starting to see some changes. That's very much on the structural side, and what we really want to see now is more thought going into how do we get things moving on the demand side. Because so often companies might be delisting because they're not getting the liquidity, they're not getting the valuation they think they deserve.
Yes, and of course, I mean, it's very interesting because just recently there's been this, I thought, rather strange call that people have been actually suggesting in certain think tanks, which one might say have certain connotations close to at least the Labour government, of suggesting that even AIM as a market should be closed down. That struck me as rather strange.
Yeah, I mean, and if you saw the first coverage of that article, Patrick, you'll have seen I was in there saying that perhaps that's not that's not the best thing at all. I think clearly AIM, which has its 30th birthday next year, has had its challenges. It's got fewer companies than it did, even a couple of years ago. But the main market has declined as well. But we still think there is a need for a distinct market for growth companies, for those entrepreneurs that think they're not ready for the main market. But it's absolutely true. Once you reform the main market, it's not at all a surprise that people start to ask, well, what is AIM for?
Of course, and I think that's quite a reasonable question to ask, what is AIM for? It's just the insta-abolitionist standpoint struck me as being a few steps beyond what was reality.
I agree, and just one point on that. I mean, these new rules that we've just put in, and not me, but the FCA have put in. I mean, there is now a it's really difficult for the main market is not for companies, I think, of a sub 30 million market cap. So, which at a stroke wipes out probably 40-50% of AIM. So just crashing these two together, simply wouldn't work.
Yes, and it's obviously very interesting because you mentioned at the start how private company and private company funding has grown a great deal. It's grown in the UK. In the US, they have a massive move towards private company markets, although I have to also say it's not actually very clear that the private company markets are necessarily doing anything that particularly impacts the public markets overall. How do you feel that's playing out in the UK at the moment?
Yeah, I think, look, there's private markets don't need to succeed, don't need to fail for public markets to succeed. I think it takes, it takes both sides to be flourishing. I think we need an ecosystem. Why were the FCA and the Bank of England looking at asset bubbles in private markets in the last couple of years? It's because we've had effectively, you haven't had that flow through. You haven't had the private going public. And what public often does with these private assets is it acts as a disinfectant. It really is a check on what a proper valuation should be. So I think it takes all sorts. I suppose one concern I've had and raised quite a lot is that the way some of our regulation is currently, you are dissuading investors from investing in the smallest stocks because fears over illiquidity, if you like, which is very much something that's lingered post the Woodford collapse. But we are straining every sinew to bring liquidity to private markets. It feels a bit oxymoronic in a way.
Very interesting. And I have to say, I broadly agree with you. I actually think we might take a little step back here. I don't wish to talk about particularly Neil Woodford, the man, or what he may have got wrong, but perhaps you can just give us a brief overview of the Woodford situation, because that may be something that our viewers in the rest of the world are not so aware of, although it was a very significant event in the UK.
So, I mean, I'm not sure I can give you chapter and verse on Woodford either, Patrick. But it was a collapse of a fund which had a number of illiquid assets in there, and I think where I come from on the sort of aftershocks from that, if you like, is that there's very, very general guidance on liquidity management from the FCA. Which really gave, I think, compliance officers all they needed to say to fund managers, well, we don't think you should be investing in this size of company anymore. And it's very, very difficult to get evidence around this. But what we can see is that in the last 5 years, which is the period since that Woodford moment, institutions that previously might have bought into the UK market when a stock reached 50 million market cap or something, some of those institutions now are not really engaging until they get to 100 million or possibly even 200 million. So what you've found is that it's really, really difficult for companies at that size to build a serious share register. And you do have people, investors who are committed to that part of the market, and you would not be surprised to hear that a number of them are QCA members because they are really underpinning those small caps. And also retail is a hugely important part of the market for small cap in the UK. But we just, now that the FCA has this secondary remit for growth and competitiveness, we wonder if there could be a little bit more clarity around what investors could or should really be doing.
Yes, and it's very interesting because I think part of the problem for Woodford was also that some of the rules relating to liquidity originally had come down from the European Union. And this is not trying to make some hideous Brexiteerian point. It's more the fact that I think the European regulators are not so used to the idea of smaller cap stocks and relative illiquidity. And that was actually something which did catch out Woodford. And in fact, I think also Woodford was caught out, if I remember correctly, by some private holdings, which essentially probably should not have been necessarily in the same form of fund vehicle or something. But it's a very, very interesting point you make over the concern about illiquidity, the importance of the FCA having a growth and competitiveness mandate that hopefully will start driving the market forward. So when you look at the reforms, I mean, just overall from a QCA kind of attitude, quite interesting reforms to the UK stock market. What are the bits that particularly please QCA members in terms of what's been decided in the UK this year?
Oh, I think look, that journey from 2020 to the 3.5-year journey to get the FCA listing rules, reformed are very positive. So I think there's more flexibility for founders that want to bring their companies to the market. There's less recourse to shareholders for various transactions that they want to do. And I suppose what it is, I mean, rather than making this making the markets that don't work for investors, I think this is making sure that it strikes a balance. As I say in all the conversations we have with regulators and with government, if you don't have companies, you don't have a market. So we need to make sure that these that the UK markets are not so out of kilter with what is offered internationally. Companies are mobile, capital is mobile. I think the one that could help the IPO pipeline along next is the prospectus review, which is something that we've just submitted on. I think this week or last week. There's a huge number of pieces of policy work at the moment that we're doing. So I think actually when you know what you have to do on the market, married up with what you have to disclose to get on the market, hopefully that shows that the UK is really open for business.
Yes, prospectuses, when you mention those, I mean, they seem to be something I find somewhat perplexing. I mean, as a teenage investor umpteen decades ago, I used to actually read prospectuses, whereas I don't think anybody in their right mind would try and read a prospectus these days, because what used to be a handy sort of 30 to 50, or maybe on a big market IPO, 100-page document, these days seem to be like 300 pages of endless legalese with the odd picture of the company in the middle just to remind you that you're trying to buy some stock. And where do you feel about the prospectus review? I mean, I'm personally of the opinion that we couldn't possibly manage to go wrong without losing 80% of the gibberish and legalese that are in prospectuses, but I'm probably just too radical for my own good.
Well, I mean, I think what runs in parallel in my mind with this is the we've done a lot of work on the length and the value of annual reports. And so we did a piece of work soon after I joined, which just really emphasized this point that, annual reports, I think we called it, I certainly wanted to call it, I think I called it the never ending story. Because, we did the sums, and I think annual reports were gaining 6,000 words every year. And the thing is though, Patrick, I think from talking to people about why they invest and about how they do their research, I think the annual report as a document still has a value. It is something that people turn to, most readily and usually first of all when they're thinking about investing in a stock, even if a lot of it is, might be boilerplate. And I think probably the prospectus is in the same category, particularly when you're thinking about smaller stocks. I mean, post MiFID II, there's been a real issue in the UK about the volume and the value of equity research of these companies. If you can't, you need as many ways as possible to be able to discover the story, the strategy, to gain the confidence to invest. So I think, although there's probably quite a few paragraphs you could take out of a prospectus, I still think there is some value there.
Oh, and don't get me wrong, I think there's huge value in a prospectus, and I think there's fabulous value in an annual report. It's just the fact that you end up with essentially what ends up being 100 pages of legalese versus a relative paucity of actual information. The information's great, and by the way, the boilerplate figures I think are fantastic, particularly if ideally everybody's boilerplate figures are easy to compare with everybody else's boilerplate figures. And obviously then we have XBRL and all those sorts of wonderful things to manage to allow us to sit at home with our spreadsheets and compare, which is wonderful. It's just this total bloat that has ended up taking things to a 250-page document, particularly where we get silly, sort of non-common sense risk disclosures, where you have to disclose essentially, the tea lady had flu twice, so therefore we think that this could be a risk because people may die of thirst in a certain scenario. Doesn't really help me as an investor. I think we've got more common sense than that. Yeah,
and well, interestingly, I mean, with the prospectus regime, I could be corrected, but I can't think of the precise number. But I do think in Brussels they were bringing in the rule with the cap on pagination for prospectuses. We didn't go that far in the UK, but you can just imagine, all of these lawyers poring over a document, and a very stern editor stood behind them saying, "Look, that's erroneous. Strike that out." And so maybe that's the old journalist in me still thinking that the power of the press.
Well, I think also it's the idea that had you had various of your editors from the Sunday Times, there's no way prospectuses or annual reports would ever been allowed to put on, particularly annual reports, you say putting on 6,000 words a year. It just wouldn't have happened. If nothing else, your owner wouldn't have allowed so many extra pages to be printed because it would have reduced their profits. So yeah, it's a very interesting point. I mean, they are vital documents and vital means with which you can communicate. How do you find, I mean, from a QCA perspective, obviously this is very exciting times, so many things going digital, so many things happening. Annual reports, in fact, which used to be mailed out as hard copies, now mostly coming to people as PDFs, etc. Does that fundamentally change, and how does that fundamentally change the ways that your members are able and want to communicate with shareholders and potential shareholders?
Well, I think just before I joined, we did do a piece of research that tried to establish the benefits of that close engagement with the retail shareholder. As I said, because some of those institutions have pulled out of the 50 million market cap part of the market. There really is a retail has filled that gap. Retail is 11% of the London market. It's 24%. On AIM, including founders and so on. So there really is a core retail holding there, and we know that companies that try can do very well engaging that audience. So where they might have done a media call and they're maybe thinking they're not getting the media coverage they're used to, or they might have done an analyst call, but there's not so much analyst interest because there is less research being written. I know a number of companies that put in a retail call on results day with someone like Investor Meet Company or something. So I think they see value in that. There is another piece of work that's going on currently, which we hope helps with the plumbing. It is still too difficult for companies to know who their ultimate owner is because of the way. Because of nominee accounts and because of paper share certificates and all sorts of stuff. So I hope that something will be announced very soon. It's a project being run by Sir Douglas Flint, formerly of HSBC, and we will see.
Gosh, now that takes me back. Paper share certificates. My goodness. I mean, seriously, is that still a significant percentage of smaller listed companies?
Not just, I would say not just smaller. I would say any. So this is an estimate. It's not my estimate. There are something like 10 million paper share certificates around the UK. Most of them in sock drawers, Patrick, I imagine. But yes, a lot of that is still on paper. So the least contentious part of the digitization review that Douglas is working on is that paper share certificates should become digital. The more contentious part is how you replumb the whole system.
Yes, I mean, I've got to say, perhaps I can comment, and you're probably going to have to be more guarded, but it certainly strikes me as understandable that we've got all of this nominee accounts because it worked from the broker end of the market. But nonetheless, in an era when lots of tax authorities say that private companies have to be totally and completely transparent about who owns them, there's a bit of a never-ending kerfuffle when it comes to public limited companies, because it's very, very hard to know actually who are the shareholders in lots of companies, thanks to this miasma of different interlinked nominees.
Yeah, I mean, I think it could be a lot simpler. There are a number of vested interests along the line here, and I do think if companies knew who owned them, then I mean, surely that is it's good governance, it's good engagement, we need a simpler system.
We need a simpler system. Also, ladies and gentlemen, we need to be finished in an hour because that's how much time we've got today. So therefore, we're halfway through the show. So I want to say thank you very much to James. We're going to come back to him in just a moment, give him a chance to ready himself for the next part of the show. want to show you one of our short videos that we ran this week. Don't forget, you can catch my slot on FinTech TV every Monday. That is at 9 a.m. Eastern, actually 9:20 a.m. to be absolutely precise, Eastern time, just ahead of the Monday morning opening bell. We're talking live to FinTech TV and Remy Blair at FinTech TV studios on the New York Stock Exchange floor at that time. We made a short video last week talking about some of the points that we'd raised in that show, discussing most of all how Europe has found itself being rushed along in the wake of the Fed. Meanwhile, in big world, the US Federal Reserve has undermined the European Central Bank. As expected, ECB had to cut euro interest rates by 25 basis points after the bazooka fired of a 0.5% rate cut last month by the Fed. What's the problem in Europe? Interest rates are coming down because inflation is low. It's below the 2% target of the ECB at 1.7, 1.8% or thereabouts. Ultimately, also, there are big problems in the overall economy of Europe. Germany, the macro powerhouse of the bloc, is once again in recession. That's going to be its second consecutive year. And indeed, it's all marked out by, look at the last 15 years, ladies and gentlemen. The European Union has grown by 9%. The USA has grown by 86%. For more in Big World, like or follow. Good grief, 9% versus 86% over the course of the last 15 years. Those growth numbers are incredible. And of course, that means that the European Union, which was basically a larger economy in 2006, 2007, 2008, is now essentially something like 20% to a third smaller than the United States of America. Quite stunning numbers altogether. Also important to bear in mind that actually, if we were to compare the European Union's G7 members with the UK is actually growing faster, which I'm sure James will be very, very happy to remind us of in just a moment, and part of his thesis as to why he's hoping that investors are going to be coming back post-Brexit to the UK markets, and particularly the smaller medium cap markets. However, let's move on for a second, ladies and gentlemen, and bring you to our book of the week. Actually, it's a very fast follow on this. Last week, we had a fantastic show with Paulina Bren. She is the author of She-Wolves, The Untold History of Women on Wall Street. And it really was just absolutely such a fantastic show. We were talking about the pioneering women from 1951 until 2001 who really started shaping female presence as members of the New York Stock Exchange, on the floors of the exchanges, and also indeed around the commodity exchanges and across the USA. This book is already in pre-production, I am told, to be an HBO or similar kind of series in the near future, and I think it's going to be brilliant. It's a really, really super book. I know that a number of readers have been writing to me this week, a number of viewers have been writing to me this week saying that they're buying it for the Christmas stockings for various people. Please go do that. It's an absolutely gripping read. It's really, really superb. And of course, if you want something that's a bit more technical, why not balance it with FTSE, the story of the brand, written by none other than our guest today, James Ashton. So as we ponder that, let's go back to James and talk about, looking at these markets, looking at the way that the UK is currently positioned, and post the listings review. What would you really like to see happening to help the QCA members going forward, James?
I think we need to, there's a lot of work being done recently, Patrick, about trying to understand whatever happened to our home buyers. So, there used to be something like, our UK pension funds used to be invested more than 40%, perhaps 50% in UK equities. And for all sorts of reasons over a generation, that's come down to about 4 or 5%. So there is some work going on. The government has a pension review at the moment. It's looking at how you can, consolidate some of those, particularly the local government pension schemes, to create more entities of scale, taking lessons from Australia and from Canada. And we hope that by doing that, you introduce the specialists who are willing to look at small and mid cap again. And there actually is a conversation in the UK about to what degree do should these funds be nudged, cajoled, arm twisted, so that UK assets back UK prospects. And I think that is something that can be done, without a wholesale shift. But a lot of the research I've seen suggests that we haven't. It's not that we've lost the home buyers. Actually, domestic investors have gone the other way. So they're investing a lot less at home than you might imagine. And I think we need to learn from markets like France, Korea, Australia, where they do back homegrown companies. So we need to look at. I think there's so much more we can do in that area.
Yes, it's very interesting, isn't it? I mean, of course, particularly France that you mentioned, I find fascinating because the French are incredibly good at backing their own homegrown countries, despite the fact that the European Union's own rules actually expressly stop them from putting in absolute must invest criteria. I mean, we saw that particularly with Poland. After all, Poland used to have this thing where the private pension funds had to invest 50% on the Warsaw Stock Exchange. The European Union said, no, you can't do that now that you're in the European Union. And finally, that was repealed around about 2010, 2011, 2012, if I remember correctly. But France has been amazing because they do still have this amazing patriotism for their own domestic French markets, even as Euronext sits as part of a 6 or 7 European Union nation empire of exchanges.
Well, I remember the time, of course, with France. I remember, writing about it. This was probably in the era of very cheap debt and the takeovers and so on. I do remember France compiled a list of their strategically important industries, and I always remember that they put yogurt on there because there was I think it was Danone they wanted to make sure never got taken over. So I don't think we need to go that far. I mean, the great strength of the UK is this is a very, very open market. But we're, welcoming of this new government's creation of industrial strategy. It's got financial services in there, which is not always the first pick for an industrial strategy, even though this is one of our great strengths. And our perspective on that is you need the capital markets within the financial services because they are powering all of that fundraising and investment for our member companies that are based all over the UK in what you might call the real economy. But yeah, I think that patriotism to a degree can be a very, very good thing. And there has been a debate here about a British ISA or whatever, which is currently in abeyance. But we think currently there's a lot of money in ISAs, the tax-free savings scheme. We're not clear why the UK government needs to give a tax break to people here to buy shares in Nvidia and Apple. Maybe some of that could be realigned around British companies. And then in terms of what's sitting in ISAs, there's something like £300 billion in cash ISAs, not making much for anybody really. How can we help UK savers become UK investors and have and kind of change their approach, their attitude to risk and reward.
And it's very interesting because you talk about changing the attitude to risk and reward. Obviously, a lot of conversation. We don't know what the results are going to be, but there's been a lot of conversation recently that the Labour government could be looking to somehow or other change individual investors' relationships to the small cap stock exchanges. Because if you invest on AIM, as I understand it, you don't have to pay UK capital gains tax and certain criteria, etc. Do you think that it's realistic to expect that that's going to continue, or is it a bad thing? And equally, are there ways to perhaps tweak the tax situation? You mentioned the idea of subsidizing Nvidia. It doesn't seem like a good idea for the British economy.
Yeah, I think there are lots of things to do. I mean, we put in our budget asks as we do every year, every 6 months, depending on when the government wants to have one. And this is not an AIM issue, but it's a market issue. We have stamp duty in the UK at the second highest rate. It's only beaten out by Ireland. And that transaction tax does not exist on Wall Street, and it's much lower in many other markets. So we don't think the government is going to turn around and repeal stamp duty in totality, because it does bring in a lot of money for them. But if you can do that outside the FTSE 100, you could do that for several £100s, not several billion. And so that would be something, and I think that would be really flicking on a light switch for a lot of these small caps. I do hope, because we have the budget next week, as you'll be well aware, Patrick. Look, we really support. This government has talked a lot about growth, the growth agenda, particularly wants to get regional growth. How do we get all the other cities firing as well as London? And I think something like those tax structures and rates and incentives that flow through from people starting up companies, selling shares when they've been successful. We don't want to tax. We don't want to overly tax success, and we also want to make sure that the incentives are there. So companies in our membership, something like the business reliefs that are currently in place on AIM, this does a wonderful job for them. This is about patient capital. So people who invest to take advantage of those reliefs, we know that money would probably otherwise just be mouldering in cash. And actually what it's doing instead is it's getting behind young companies at just the point that they need money to get behind them. When you're starting out pretty early on your journey as a company, there's so much unpredictability, whether it's launching products, going into new markets, or hiring people. So to know that you've got patient capital behind you is a really, really valuable thing. And we know that's been one of the benefits of being on AIM for many of these companies.
And that's very interesting. Sorry if I went static there for a moment, ladies and gentlemen, but it's a fascinating point. And actually, moving on from the taxation issue, which I think you've summarized beautifully, and it is, of course, a much more complex issue than just tax or not to tax, the regions. Talk to us a little bit, because first of all, I mean, QCA membership, you're very well spread throughout the Highlands and Islands and regions of the UK.
Yeah, I think, look, we would obviously, because, so if I explain, so about a third of our membership would be advisors. So this is really the experts in the city. Most of them in London, some are not. They're in Cambridge, they're in Manchester, the various places. It's the advisors, brokers, accountants, lawyers, PRs, registrars, all sorts of the support system to the companies. But the companies some are based in London, but absolutely some are based all over the place. So I always talk about fintechs in Huddersfield, my hometown. I talk about vehicle tracking companies doing brilliant things in mid Wales. A company that's putting in place a battery storage park in South Wales, digital media in Glasgow, pawnbrokers in Middlesbrough. I mean, these are the companies that turn to London and turn to the capital markets to raise the funds to expand and to invest.
Yes, and I mean, that's a fascinating pointer. But then let me ask you another question. Do you think that, I mean, we're now, good grief, 50 years on from the unifying of the London Stock Exchange and all of the regional stock exchanges? Have we ended up with too much capitalization, too many nomads that are really very, very centered on the City of London rather than the regions? Is that something that could help improve the life of your members and indeed future small businesses?
Yeah, I think it's very difficult, because so where are we with those nomads and firms currently? Look, it's been a difficult few years. So we've seen consolidation among those advisory firms. It almost feels like they've all paired off in the last in the last few years. So I think some of them have absolutely have experience and knowledge of regional cities and towns and so on. But I think it would be, given where we are, we haven't got that many IPOs currently. We do hope there are more to come. I think it will be a very, very brave advisor that, for example, opened an office in, insert town or city here, Leeds, Edinburgh, whatever. I think really it's probably about them, going out to see those companies and the companies coming to London. But I don't think you're going to see that kind of dispersal again. And I don't think we need regional exchanges.
Interesting, very interesting points altogether, and I'm quite fascinated to hear that, because I'm not entirely convinced. I think we could probably do with regional exchanges to a degree, although at this point it might not be the ideal thing. However, very, very clear answers, which is very, very useful. So when you look at this agenda, I mean, what are the key things that obviously you're looking at right now, and the research that you're doing that we can look forward to in the near future, if you can tell us?
Well, if I just say what we've done, if it's helpful to say what we've done this year, and I try, so a couple of pieces of research we've done in particular, and I suppose, where do our ideas come from? Well, they bubble up from members. what are we try to celebrate members. We do that a lot more than we ever did on social media now. We have those examples that we pull out. But 2 pieces of research we did this year, it doesn't add up, the soaring cost of audit. And this came from, just chance remarks from, I would always say to a CEO or to a company secretary, what's on your mind? And, to hear different companies comparing notes at our dinners, you'll never believe what happens to my audit costs and so on. So we did a piece of research, because the one challenge with our market sometimes, Patrick, is it is under-researched. And, we found that typically over a 5-year period, companies, and I'm just going to check my notes. So we surveyed companies on the main market, on AIM and Aquis. And so these are all sub 500 million market cap companies. They were typically paying £300,000 more compared to 5 years ago for their audit. And if you think about the revenue base and the cost structure, I mean, that's a huge leap. That's a 75% leap in 5 years. So that was one piece of work we did. That's gone into the Financial Reporting Council, who've also got a growth remit now, and that's been a very fruitful conversation. We know that they're really scrutinizing the SME audit market now, and how you can bring more competition into that part of the market. And the second piece of work we've done is around proxy advisors, which we called, you'll note we try and have interesting headlines on these reports. So this was called Publish and Be Damned. And we really have concerns that the proxy advisors are not promoting the best interests of our companies. There's a real challenge to engage with them, either within the AGM season or without. And there's evidence that they are holding smaller companies to too high a standard, to a standard that some of these advisors have created for themselves. And so big concerns about that. And there is a review of the stewardship code in the UK that will there will be a consultation on very, very soon. So we want to play into that. So I suppose what I'm trying to do is really grasp the nettle, the issues where sometimes companies have rolled their eyes, and I mean, having been to a dinner with a group of company secretaries just as they head into the AGM season, I mean, goodness me, it was quite a depressing evening.
Well, those are very, very good points, and also remind us of one of the reasons why I wanted you to come on the show, because the QCA does great work. And I think even compared to other national bodies that are trying to represent their small, medium enterprise issuers, you have an incredible panoply of things that you're doing at all times. The audit point, I think, is particularly fascinating, given the fact that actually one of the areas where I would say the UK's corporate code is brilliant is in excluding very, very, very micro-sized companies from being audited at all, because actually, what does it matter if they're under 200, 250,000 pounds? And that's a piece of genius that does not apply. And a lot of people go to other countries in, say, Europe, around the world, and suddenly find themselves paying X thousand for a company that's basically doing no turnover whatsoever. So it is absurd that we're seeing such a high rating for those audit fees for the smaller quoted companies, because let's face it, they're not growing exponentially by those sorts of rates in order to justify the added audit. I mean, if you're growing at the rate of, I don't know, a certain degree of Bayesian logic, then it's obviously okay to pay the extra audit. But when it's essentially on companies that are just growing slightly generically, it seems quite insane. That's a fascinating point altogether. And I suppose looking at that panoply of all of your research, everything that you've got coming together, this seems as good a moment as any to ask you the big question, James Ashton, for being on the show. Where do you think the capital market revolution goes next?
Well, I thought about this a lot, Patrick. I think I hope we're heading towards a retail revolution. I hope that buying shares becomes as easy as buying crypto. It certainly should be. And I think that's a combination of people taking more interest in their retirement plans, in what they've got put away for themselves. I think it's something about fixing the plumbing so that companies can really engage with their ultimate beneficial owner. And I think it's about promotion and getting people engaged with the company at the bottom of their street, perhaps their employer. But I really hope that we can have a retail revolution going forward.
A retail revolution, ladies and gentlemen. What a fantastic point. And actually, in many ways, you're echoing, would you believe, the words of Matt Chamberlain, the CEO of the London Metals Exchange, somebody for whom there will never be a retail revolution in his exchange, I don't believe. But he was saying similar sorts of things a few years ago on the show. And it's certainly something which I think has to be taken on board if we watch previous shows with, for example, Paul Conn of Computershare talking about the plumbing. I think you make some very, very key points. Overall, look, it's been a joy to have you on the show, James. I really, really appreciate your time. The QCA are leading the way, I think, better than so many other SME listed company organizations around the world for small and mid caps. And I want you to continue to succeed. And I sincerely hope that the UK government is listening to you for the future, because that's really, really important. One person who is listening to us this evening is none other than guest on IPO-VID number 15, Mark Makepeace. This is a terrific book. He says, I thoroughly agree, everybody should read it. He says of the book that, of course, was produced by James Ashton and Mark Makepeace. FTSE, the inside story. It's a terrific read, ladies and gentlemen. Book of the week for us a couple of years ago. Absolutely worth a read at all points in time. Similarly, follow the work of the QCA, the Quoted Companies Alliance. Don't forget to pick up a copy of Paulina Bren's absolutely marvellous She-Wolves, this week's Book of the Week. Catch us Monday through Friday in Exchange Invest, the Bulletin of the Bourse Business, the exchange of information. Next week, we got something completely different. We've got Yasser Benjelloun Touimi. He's going to be on IPO-VID number 158. We're going to be bringing art to market. He's talking about interesting new MTF market, Artex, which is going to be quite fascinating to discuss that whole business of how you can manage to create a stock market for paintings and other fabulous artifacts. It only remains for me, ladies and gentlemen, to say my name is Patrick L. Young. Thank you very much for watching this show about the Quoted Companies Alliance along with James Ashton. Let me thank our fabulous production team today, Desiree, Marianne and Rushlin. And I wish you all a great week in life and markets. And we look forward to seeing you same place, same time next week.